Based on a discussion with Professor Arun Kumar on an Indian channel The Wire regarding how vulnerable will Indian economy be in 2026, the discussion centers on significant vulnerabilities facing the Indian economy as it heads into 2026. A primary concern is the external sector, marked by substantial negative foreign portfolio investment outflows, around $18 billion, barely positive net FDI, and a consistently weakening rupee. India stands alone among major economies in seeing its currency depreciate against the US dollar by about 8% in 2025, while others have gained. This fragility is compounded by the failure to secure a trade deal with the US, India's largest trading partner, creating uncertainty for exports amid fears of a global tariff war. A core argument, presented by economist Professor Arun Kumar and gaining wider institutional traction, including from the IMF and former chief economic advisor Arvind Subramanian, challenges the official GDP growth narrative. Kumar contends that India's GDP is substantially overestimated by about 4 percentage points annually, leading to a cumulative error of roughly 48% since demonetization. He estimates the real growth rate is around 2 to 2.5%, not the official 6.5 to 8.2%. The error stems from methodological flaws in capturing the unorganized sector, which constitutes 45% of GDP. This sector has been declining due to shocks like demonetization, GST, and COVID-19, but its data is inaccurately proxied by the growing organized sector. This data discrepancy creates a misleading macro picture, explaining contradictions like high claim growth alongside low capacity utilization, 75%, and weak private investment due to inadequate domestic demand. The integrity of India's economic data is now under serious doubt globally, eroding investor confidence. This data uncertainty, combined with trade policy uncertainty, is deterring foreign investment. Capital outflows are exacerbated by a weakening rupee, which reduces dollar returns for foreign investors, and by attractive alternatives like the U.S. tech market. The potential U.S. trade deal looms as a double-edged sword. Concessions sought by the U.S., particularly in agriculture and services, like insurance and banking, could trigger domestic political unrest. Recent policy moves, such as amendments to rural employment schemes, MG and Rega, and new labor codes, are interpreted as preparatory steps for such concessions. Opening agriculture could devastate Indian farmers, who receive minimal subsidies compared to heavily subsidized U.S. farmers, potentially provoking large-scale protests from farmers and workers. The discussion concludes that India's fragility stems from twin pressures: external vulnerability due to U.S. trade policy, and weak internal demand from the struggling unorganized sector, where 94% of the workforce is employed. To address this, a fundamental mindset shift in policy is recommended. Instead of focusing on the organized sector and external markets, the government should bolster the internal economy by boosting incomes and demand in the unorganized and agricultural sectors through strengthened rural employment schemes and increased spending on health, education, and rural development. Forcing the unorganized sector to formalize top-down is seen as counterproductive. Supportive policies for organic growth are essential. The upcoming budget is viewed as a critical test of whether the government will pivot towards these domestic demand-boosting measures to navigate the gathering economic storm in 2026.